super excited to have Zach Beach on this call. He has tons and tons of experience. He's done a lot. He's written books. His company has featured on a couple of times on Inc. 5000. Hey guys, welcome to our weekly mastermind call. My name is Sharad. I'm the owner and founder of Recently and also an active investor in Northwest Indiana market, right outside of Chicago. I do buy and hold, fix and flip, and a little bit of wholesaling, but our fix and flip is to other investors that are buying turnkey properties. And I also own a property management company with about 185 units roughly, with about 50 of my own units in there. And then on these weekly calls, for the last few weeks, we've been having an expert come on these calls and just share about specific topic from area of their expertise. So this week, super excited to have Zach Beach on this call. He has tons and tons of experience. He's done a lot. He's written books. His company has featured on a couple of times on Inc. 5000. Is that correct?
Yeah, back-to-back years. Yeah.
Awesome, man. Yeah, I mean, if you don't mind just giving a little bit of background, and then if you have a presentation that you want to do, or we can jump right into Q&A, whatever works best for you.
Yeah, 100%. I think it'll just be based upon the experience level everyone here. As far as creative financing, I'm happy to cover basics. I got case studies, you name it. So, and then just so I know, Sharad, what do we have for a time frame here?
We have roughly about an hour.
Okay, perfect. No, I'm good. I'll be able to make sure we deliver a ton of value here today. But first and foremost, I'm Zach Beach. I'm the CEO of Smart Real Estate Coach. My partner and I have been doing real estate transactions. My partner is actually my father-in-law, Chris, who got crushed in 2008 and had to really re-engineer his real estate business. I ended up joining him while he was in that re-engineer process. And I was a bartender and personal trainer just a short 8 years ago. Now all we do is buy and sell real estate through creative financing, which simply means that, we're not using banks, we're not using our own personal credit, and we're not, putting large down payments. From there, we not only buy and sell real estate here in New England, Mass, Rhode Island, and Connecticut, but we also work with students across the entire country. We call them associates. We've been in Chicago now for about 3 years. We've done a ton of creative financing deals in and around that area. We're in 80 plus markets. So very likely if you're on here, you're in a market that we're currently doing deals in, and happy to share kind of all of the tips and secrets in order to do creative financing deals. So I can certainly go from this, Sharad, I have a presentation I'm happy to walk through, but also,
please go ahead, man.
Also, I'm happy to make sure if we get a quick lay of the room, I think that'd be helpful. So if you guys wouldn't mind, I like either utilizing the chat, or if you could turn your camera, that way I'm not a talking head here as well. I'd like to make this as interactive and as possible, as I know that if you're sitting here, you're interacting, it's way more likely you're going to be able to pull some of these concepts and actually go put them into play. And then at the end, what I'll make sure is we'll give you a link to be able to go get our Amazon bestselling book, New Rule, or Real Estate on Your Terms. Give you an additional book and the ability to jump on a strategy call with one of our teammates as well. So that way you can not only, learn from here today, but be able to go dive deeper into the subject if creative financing is something you want to either add on to your current business or to pursue as your main real estate model. So with that being said, if you could just type in the chat, tell me, are you actively doing real estate deals? So at least I can get a good lay of the land here. If you're actively doing real estate deals, all you gotta do is type yes. And if you wouldn't mind, when you type yes, Mike says yes, Rod says yes, just type in what type of transactions. It could be, obviously fix and flip, buy and hold. You could be doing, apartments, condo, you name it. We got fix and flip, buy and hold, seller finances, Kevin. So, all right, good. Wholesale, single family, multifamily, not yet new to the business. Totally okay. Oh, New Hampshire. Kyle, you're up in our neck of the woods. I love it. Okay. So some of these concepts are going to be, or the way in which we buy and sell real estate is going to be familiar to some. So that way we don't hit on a ton of redundancy. I'll go through some of the basics pretty quickly, but then also what we'll do is I'll skip ahead in a lot of this presentation in order to show you some real deals. Because that, in my opinion, is what tends to bring the most questions when it comes to Q&A. And then of course, once you guys have questions, it's very likely I even have a case study in here that relates to that question, and I'll skip around. I mean, there's no real set presentation. We're not selling anything here. So we're just going to continue to help you be able to do real estate deals. So hopefully you guys get a ton of value from today as well. So let me just quickly, I'll just go ahead and share my screen here over on the left.
What's up?
Awesome. Yeah. So again, I'm Zach Beach, CEO of Smart Real Estate Coach. Couple disclosures, if you haven't realized it, with all the wicked smart stuff, I'm from Massachusetts, but I'm currently sitting actually in Newport, Rhode Island. That's where we're based out of. Actually, today happens to be one of those special days is we have office visits where our students come and we really dive into their business when they show up here. So if you hear any background noise, that's just what's happening. And like the next room over is where we're helping somebody build and scale their business as well. There's no way of doing real estate deals. And fortunately and unfortunately, it sounds like some of you are doing that. And that's real estate transactions that produce one payday on these deals. That could come in the form of realtor commissions, rental income, wholesale, fix and flip, you name it. And my family has been doing that for a long period of time, and they will never give back any single dollar they made doing those things. But today we're really going to talk about the new way of buying real estate, which is getting paid 3 times. So by the end of today, I really want to make sure that you guys get access to not only the Real Estate on Your Terms, Deal Structure Overtime, which is a book where we actually go behind the scenes of all of our deals, and then make sure you get a call set up there as well. Because today we're going to talk about the new way of buying real estate, which is really getting paid 3 times. So I'm going to walk you through how to utilize creative financing in order to get paid 3 times on every single deal that you do. So I did briefly go over how we got here, which was, again, my father-in-law was a broker owner for 18 years, did fix and flips, raised the roof projects. Was anybody else affected by 2008 in this room? You just type in yes. What's interesting is
I was, but in a positive way. Yeah, well, I started buying right after 2008. So I would say I got the benefit of that down market.
Well, the good thing is we're about to see another swing for real estate investors right now as well through the COVID market, which is those that are just getting started right now, especially looking to get involved in creative financing. I mean, you are in a very strong position to buy real estate consistently. My brother-in-law also joined in 2014. He was a realtor for 8 years. And then I joined when I was a bartender and personal trainer in 2015. And that's when I decided to go ahead and join the business. I did briefly go over this, say we are a family team. So the top left-hand corner, you got my brother-in-law, Nick, my father-in-law, Chris, myself. Then you got my kids down the bottom right-hand corner there as well. And there's some of the deals I'm going to talk about here today that we may get into them where my kids will definitely be able to benefit from those deals, which is pretty cool to say that in creative financing. So everything we talk about today is exactly what we do. So you're not learning from anybody that did deals one time ago. We were literally just sitting in the room before I jumped on here and talking about a transaction that we're doing in Valdosta, Georgia right now. That's a $1.5 million house, debt-free, free and clear, 10 grand down on this property. There's a pool inside the house. So you can do these transactions, basic deals, $100,000 homes all the way up to 1.5 and beyond, as we did a bunch in DC in that price range as well. Those usually 4 things that hold people back: not enough time, not enough money, not enough experience, and not enough support. But based upon what you guys are sharing with me, it's about 90% of the room are actively doing real estate deals. So we'll continue to push things forward here as well. So when I talk about creative financing, this is for many different people when it comes to creative financing. It's supplemental income, replacement income. You can utilize your IRA and Coverdell. I remember sitting when I first got involved in real estate investing with my father-in-law, Chris, and we bought a 6-unit building, owner financing, which means it's debt-free. And the seller actually paid us $7,400 to go ahead and acquire this piece of real estate because we closed on at the beginning of the month, which means that he had to give us all of the income that he was receiving, all the monthly cash flow and all the security deposits. So if you're interested in doing multifamilies, great spot to be in. Also, if you want to go ahead and acquire your own home, this was a property that I bought. I was self-employed. I couldn't go get a bank loan. Me and my wife acquired this property as actually our first deal for our own personal residence. So if you're just interested in buying your own piece of real estate, this was right on the Sakonnet River in Rhode Island. So great location there as well. We paid $2,500 down on this lease option and lived in it and exited out in about 24 months with about $113,000 in profit on this deal. So buying your own property is a really cool spot there as well. So let me tell you really what I mean so that we can lay down some basics here when I talk about creative financing. So, or terms, depending upon where you heard it. No banks, no large down payments, and no credit or personally guaranteeing any debt. To my family and the students across the country, we control anywhere from $60 to $100 million worth of real estate at any given time. None of that has been personally guaranteed. None of that has gone and got bank loans on any of these properties or any large down payments. So there's three ways in which we buy real estate. One is owner finance. Two is buying properties subject to the existing loan. And three is buying properties on a lease purchase or a lease option. So when I talk about owner finance, there's roughly a third of the properties in the United States that are debt-free. So these are sellers that are willing and able to become your bank. I know I just used that brief example of this property in Valdosta, Georgia. This student just got that first deal within 60 days of starting with us. And we were able to work with that particular seller, and they were interested in selling this property because they wanted a very specific purchase price. And because they wanted that specific purchase price, we were able to then create the terms of the agreement. So the monthly payment is relatively small compared to the purchase price on that property, small $10,000 down payment on a $1.5 million house. So these are sellers that are willing to be your bank. So what you simply do is you're going to agree to create the terms of that agreement, and then you're going to close on it with a purchase and sale agreement. And that purchase and sale agreement I just have over here on the left-hand side as well, because really what's happening is because there's no debt on the property, the title is going to transfer to your company, and then a new mortgage is going to be created that the seller is now holding the mortgage. They're going to become your bank, and now you're just making monthly payments to them until a time in which you're going to cash this property out. For the example that I'm using for that deal, we actually have a 10-year balloon on this property. So the seller needs to be cashed out in 10 years. Because I know you guys are actively doing deals, I'll stop in between each one of these techniques. So any questions specifically on owner finance? And then we'll move on to the next one.
Yeah, I have a question. So you do 10-year balloon and the 30-year amortization. Is that kind of what you do standard?
So actually standard wise, if we were looking at owner financing deals, standard is 0% interest, principal only payments, somewhere between 5 and 10-year balloon. When you start getting out into like the 7, 10-year, 20, 30-year, there tends to then seller is going to look for an interest rate. And if we were to do an interest rate, it's very likely a yes. It's going to be a 30-year, sometimes even a 40-year amortization, which would allow that monthly payment to go down in order to, you'd be able to create more of a spread. Yes, over, so let me give you another example. So we bought a property, actually it happens to be in Georgia again. It's just happened to be 2 recent deals we're doing. This seller, this property went through probate because the husband actually owned the piece of property. The husband died. He didn't have a will set up, so the property had to go through probate. Debt-free property. When one of our students approached that seller, what we ended up structuring was 2 years of 0% interest, so 2 years of principal only payments. Then from there, it moved to a 3.5% interest rate, 30 amortization with a 15-year balloon. So there's within creative financing, I'm just giving you 2 completely different options here. Within creative financing, it's really about solving a problem. Because let's say that the second option I was talking about there, what the wife wanted, because she was actually going to put this property in a trust. What the wife wants is all she wants is just monthly cash flow without having to maintain a property. That property became a burden to her, became an asset to us. So we actually just recently closed on that property, making monthly payments while we go ahead and fill this property.
And there was a question. Are they able to get a copy of, if they want to get a copy of the purchase and sales agreement, should they get in touch with you or the one that you use in your business?
Yeah, I'd be happy to do it for your group. Yeah, normally you'd have to go get into our course, but I'd be happy to give it to you for your group. Yeah, just if you want to send me a message afterwards, I'll get you the copies you can distribute.
Thanks, man.
Yeah, of course. Any other questions on owner finance?
No,
Cool.
I'm monitoring the chat here. Looks good, man.
All right, cool. The secondary way in which we buy creative financing is buying property subject to the existing loan. So when you buy a property subject to the existing loan, what it really means is you're approaching a seller, complete opposite of the first one. You're approaching a seller that has debt on the house, that has a mortgage. So what you then do is you would go ahead and close on the property. So title would transfer. So utilizing a purchase and sale agreement, you're going to close on it. And I know that if you're an experienced investor, you're sitting here telling me, no, there's many ways in which you can close on a property. If there's existing debt, you could do it with a purchase and sale, you could do it with a land contract, you could do it for a contract for deed and escrow. There's different ways that you could close on it with a trust. There's different ways in which you can structure it. But just to keep it simple here today, close on with a purchase and sale agreement. The mortgage remains attached to the seller's credit. So in this purchase sale agreement, it will have an existing loan section in it. And also when you go get the closing documents on the HUD, it will also have that you're closing on it subject to the existing loan. So that will remain attached to the seller's credit. And then you are contractually obligated to continue to make those monthly payments on the property until a time in which you're going to go ahead and pay off that loan. So you're making the monthly payments to the seller. You, because you hold title, are getting all the tax benefits associated with that property. And then you're just going to continue to make those payments. Which I'll share with you in a minute, how we exit. So we're going to go ahead and place our buyer in the house. We're going to collect the payments. We're going to then make the payments. And then we're going to now benefit from being the homeowner.
All right. A couple of questions. Ricky
Sure
had a question. Is there, I'm sorry?
I say, I'm sure there is. This is usually what causes most questions.
No, I think it's about the previous one. Is there anything called like an option to extend a balloon payment?
Yeah, I mean, you can always renegotiate these deals consistently on any of these transactions. As soon as you're in them, absolutely. So when I'm going to share with you in a minute here, what we would consider a lease purchase or a lease option, we have actually, moved the lease option to a subject to deal quite often. Like we changed the agreement in the meantime. There's a deal, and let me see if there's a deal. Let me walk you through this. Let me see if I can find it here for a second. If I can find this deal for you real quick. And actually what happened was, as I searched for this thing, what happened was we bought a property. Here it is. We bought this property on owner finance. And I know I didn't walk you through the 3 paydays. So let me not to overwhelm you here. We bought this property for $183,000 with a 48-month balloon payment. You can see that in the bottom left-hand corner. No money down, a $923 a month principal only payment. Okay. What we then did was during the course of this deal, we actually approached the seller roughly around, the holidays. And we said, hey, we have some money coming in from another deal. If we went ahead and gave you, I believe it was $6,000, would you extend the balloon an additional year? So we did that for 2 years in a row because we knew if we gave them 6, we were going to roughly make $12,000 to $14,000 based on cash flow, based on the principal pay down, because the $6,000 that we were giving them was going directly towards the mortgage balance. Then what we then did was we actually approached the seller and said, what happens if we gave you interest? Would you be open to extending this deal 15 years? The seller said, yep, we'd be interested in doing that. This ended up turning into a 21-year deal.
Yeah.
Does that make sense?
Yep. All right. There are a couple of questions. Lane has a question. When purchasing sub 2, how does the seller get around having an existing mortgage that you took over if they are trying to get another mortgage?
Yeah, great question. So depending upon the seller, right? Buying a property subject to the existing loan, there's many reasons and why a seller would sell this way. Most of the time, the seller is going to be selling because they're in a financial bind. They're either behind on payments, there's no equity in the deal. So some of the sellers in which we buy from, we're not expecting that they're going to go get another loan. But let's assume that they do. So the seller that needs to go get another loan, when you close on this property, it's very likely you're going to have to utilize another technique or an instrument called like a wrap mortgage. Because what that will then do is that will show that that underlying debt is being paid and serviced. So when it showed that that's being paid and serviced, now that should come off of either 70 to 100% of that monthly payment should come off their debt to income ratio. It would be no different than if you had a rental property that a tenant was paying, you were able to show the tenant was paying, which then could come off your debt to income ratio. Does that make sense?
Cool. It does. Lane, do you have any follow-up questions to that? Nope. So good. And Kwaje, hey Kwaje, let me know if I'm mispronouncing your name. He said, how practical is it to wholesale sub two?
How practical is it? What? I'm sorry.
How practical is it to do wholesale deal using sub two financing?
I don't do wholesale deals. Quite frankly, if you're gonna put in the effort to do if you're gonna go put in the effort to put together a transaction, then why not try to hold the property and by buying it, creative financing, so you can create consistent income versus having to go look for another deal. Again, personal preference. Is it possible to wholesale a sub two deal? Yes. If I'm a buyer from the wholesaler though, like if you have a creative financing buyer, what you'd want to do, in my opinion, is to go get that creative financing buyer's agreement to buy it sub two, because it's like, so myself, I wouldn't want to inherit another person's subject to agreement. It's because there are so many moving parts. So that would be how I would structure it.
So you would want to have your own, just make sure you kind of agreed to the terms. You're not agreed to somebody else's terms.
Yeah, because so we spent like tens of thousands of dollars, which I'm sure many of you have, on your agreements, and then try to get your attorney to review someone else's sub two agreement, especially because they're most likely a long-term deal. That would add another layer of complexity I wouldn't want.
Yeah. And Melvin has a question. Do you walk away from leads where the seller only wants cash only and they're not interested in any creative financing?
Me personally, yes. Yep. Yeah, that's all we do is creative financing deals. We're not cash buyers, we're not wholesalers, we're not fix and flippers.
I mean, if they specialize. I think the question is, like, if they want cash only, like, do you even make them an offer of seller financing? Or if they say, hey, we're not interested, you're just kind of, the lead is dead at that point.
So the way in which we would approach the seller, if they said, hey, no matter what, I only want cash and I only want retail and cash, that'd be the only time we wouldn't look at a deal. Okay. It's our personal preference not to go buy properties cash. So what we would do is we would just move that into our follow-up folder until their motivation is higher, where they're interested in doing something creative, or go ahead and refer it to somebody.
Cool. And one question I have is, let's say you close on a property subject to the deed is getting recorded at the recorder's office. Is that correct?
Yeah, the title, yes, title's being transferred. Absolutely.
And then who has the first lien on the property?
It would be the bank.
It would be the bank. And so have you had any situations where what is that, like the due on sale clause got triggered?
So that's the number one question I always get, right? When it comes to subject to deals. We've never had a due on sales clause be called. We've done many of these deals and never had one being called. It does not, I want to say this on record, it does not mean that they couldn't be called. There are other techniques. So let me give you an example. We are buying a lot of properties in Scranton, Pennsylvania. And there's a local bank there calling loans due. Like this is something we consistently see. There was a bank specifically doing that. So the attorney that we had in that area recommended we started buying properties on a contract for deed. On a contract for deed. So on a contract for deed, basically what's happening is that title really does not transfer until the final payment is made. But at least our accountant is willing to go ahead and bring the contract for deed property on our books so we can depreciate as if we're homeowners. So with that, that's the way we would approach if we knew that there was a lot of due on sales clause being called. But here's my, again, personal opinion. Based upon the current team that we have surrounded with us, the current investors that we're a part of, I'm sure if you ask this exact same question, like the family mastermind, people would give you very similar answers. And that is banks, in my opinion, don't care that much about a due on sales clause. What they care about is that they're making interest off of the mortgage that they wrote and that they have collateral, which would be the house, because they still would be personally in possession if somebody didn't make those payments. So you, as the real estate investor, if you are making your payments on time, it's very unlikely the due on sales clause would be called. Now, I'll give you some additional stuff just because I know that we get some advanced people in here, and that is the way in which our attorneys suggest that we acquire these pieces of property is through a family trust. So if we go ahead and buy a property subject to, we'd buy it in a family trust that would be named the street address of the current property we're buying and the seller's last name family trust. So it'd be like 123 Jump Street, Smith Family Trust, with then the beneficiary being your LLC. Because the Garn-Saint-Germain Act of 82 states that property can be transferred for estate or tax planning purposes without a due on sales clause being called. So many people, like myself, move even their personal residence into a trust. So that's the way we do it. We have it set up in a trust. Again, this is an attorney. This is our attorney's suggestion. I am not an attorney. In order to acquire it that way, because it just adds another layer of protection for you as the real estate investor. I know I went deep there.
I think you're up. Yeah, I think you're absolutely right. That's what I've heard from other investors. Like they buy the property in a trust and then just, then it doesn't trigger that. So yeah, great. One last question is, when you're making the payment to the seller, are you making payment to the seller or are you making payment directly to the bank? Like, how do you make sure that the money that you're sending to the seller is actually paying the bank?
Yeah, I always make the payments directly to the bank. The only time we ever make a payment to the seller is if we're doing owner finance and they are our bank. We want to be able to control that. And sellers will ask about that. It happens. And the way we always explain it in a good script is, Mr. Seller, we buy a lot of real estate. It's a lot easier for you to have access to the mortgage so you can check on me versus me paying all of these sellers and checking on 30, 50, 100 properties every month in order to make sure that you guys are making the payments the right place. So we always give them the ability to go ahead and check on us as far as that will make them comfortable if that's what they want. But the truth is, with most subject to deals, Sharad, we're actually improving their credit because they either stopped making payments or they're not in a good financial position to continue to make payments. And we've actually increased people's credit scores because we're making payments and it's still attached to their credit.
Nice. And are you using a third-party loan servicing company, or you're just like managing with your scale, you're managing everything in-house?
Yeah, we're managing everything in-house consistently. You can certainly use a service provider if you choose.
Cool. All right. No, man, great information so far.
Awesome. The other option in which we do is a lease purchase agreement. So also known as a lease option. Really, all this means is you utilize an agreement like a lease with an option to purchase real estate, and you really are controlling an asset without ownership. Because when you buy a property on a lease purchase, you're really just agreeing to a specific purchase price or an equity position in the property. And I can explain that when we go over maybe a case study here. An equity position on the property, you're agreeing to handle any and all responsibilities, including maintenance, mortgage, taxes, insurance, any and all future repairs. You're basically controlling that asset with the intent to go ahead and cash the seller out on and before a specific end date or before your option comes due. So it's control without ownership. A lot of new real estate investors utilize lease options to get involved in creative financing because it's really simple. There's no, a lot of the times in which we do these deals, there's really no attorneys involved. You can get it simply done through DocuSign and a lot of these because it's an option versus having to go through a closing process. Also, a lot of these deals are done with no money down and you just have full control over the asset. So you handle that through a lease purchase agreement or a lease with an option to buy. Any questions on a lease purchase?
So with this one, I mean, again, you are controlling the terms and just for all the three kind of, the options that you have mentioned, like, are you, I mean, maybe we'll get into this a little bit later.
Sure.
So basically, are you still doing direct seller to marketing or direct marketing to seller? And then instead of buying for cash, you're offering them creative financing. Is that the same idea? Like, how are you getting these leads?
Yeah, we've We've actually been acquiring our leads from some really simple lead sources for a long time, which are expired listings, for sale by owners, for rent by owners. And yeah, what we're doing, Shiraz, we're just solving different problems, right? If a seller is open to taking 40 cents, 50 cents, 60 cents on the dollar, it's very unlikely that they're our seller because we're solving a different challenge. Really, our sellers, which is really the next thing, which is our sellers tend to look to maximize profits, right? They want either a certain price in mind or they want to cash flow the property. They're not interested in selling at that low price. And don't get me wrong, if you're actively wholesaling or you're actively buying cash property, you can definitely get sellers to owner finance even on a discount. But majority of the sellers that we're working with, we're working in that, it's also known as like the pretty houses, right? It's the nice move-in ready homes. That's consistently the deals we work with. So if you're actively out there doing any of those other techniques that we're talking about, wholesale, fix and flip, if you're a realtor, this is a great additional method to slap onto your current business. Like, so for example, we're doing deals with a group of investors right outside of Detroit. They're actively doing wholesale deals. We stepped in within the first 30 days. We're working on 2 creative financing deals from leads in which they were throwing away. Because when you approach a seller and they say, all right, I'm not willing to take, the profit mark or the 40, 60, and I'm using that number, generically right now.
Right.
But I'm not willing to take a cash offer. It's like, okay, well now, all right, if that doesn't get you to your problem, if that doesn't solve your problem, well, I may have some other options I could get you. Maybe it's price. That could get you closer to a retail price, but you're willing to take it over time. So these sellers typically are looking to maximize profits, looking for debt relief, right? If a seller right now is making 2 mortgage payments because they just relocated, which happens quite often, and they simply need somebody to continue to start making their monthly payments right away and get them debt relief, that's us. Somebody's behind on in arrears, looking for debt relief, that could be us. So that's another way in which we help people.
So basically you are telling the seller, okay, I'll agree to your price, do you agree to my terms, right? If they want the price that they do, then they have to take your terms essentially.
Yes, Rod, that's a simple way to put it.
Right.
It could be price, right? A simple script that we use is, all right, Mr. and Mrs. Seller, you gotta tell me what's most important to you. Is it price? Is it interest rate? Is it time frame? Like for a balloon payment, like what's most important to you? Because I could give you probably 1, maybe 2, but I can't give you all of it. So you just pinpointing what's most important to them, and then you create terms that make sense for your company to buy it if it does, right? Because not just because somebody's open to creative financing doesn't mean that you should take the deal either.
Sure.
As long as the terms make sense for you and make sense for the seller, then you get yourself a deal.
There's a couple of questions. Kwaja has a question: with no bank, no large down payment, no credit, how can a newbie navigate this newfound path to success? So Zach, what I'll do is I'll have him get in touch with your team and just kind of take it offline if that's okay, because I would imagine this would be more in-depth conversation than to answer over the call.
When we hop off here, before I hop off, I'm going to just give you a link. You can literally just go, it's a simple form to go fill out. We will literally ship you our Amazon best-selling books. We'll make sure you got a strategy call if you want to talk with our team.
Perfect.
You can integrate this. So
that's awesome.
We'll take it offline.
And then Ricky has a question: can this be done in most of the states with the lease purchase? The third option that you mentioned, is there any state like New York, California, generally
Texas.
They have their own, Texas?
Texas is very hard to do lease purchases. I know some people say like, hey, it's illegal. It's not. It's just they're very strict on how you do a lease option down there. But the best way to look at that is you have to have ownership on the property in order to do a lease option, or you're limited to, I believe it's a 6-month lease option. And what I mean by that is a sandwich lease. So that is when you acquire a property on a lease purchase and you sell it on a lease purchase. That's known as a sandwich lease. So in Texas, you have to have title in order to do so, to sell it on a lease purchase.
Okay.
But the rules or the laws in Texas make it more advantageous for a creative financing investor to sell the property on a wrap mortgage and to buy them on sub-2 and owner finance, because the foreclosure laws in Texas are faster than the eviction laws. So if you're in Texas, I would just be recommending you focus on sub-2 and owner financing.
Yep, great info, man. Jeremy has a comment. None of the sellers I've gotten to talk to want to even sell owner financing. Easier said than done. Sadly, real estate prices in my area are still incredibly high, and everyone wants a ton for junk. I mean, I've done owner financing. This is how I did it a while back. Once I agreed with the seller on a price, I said, look, I can pay you this cash, and then I don't know what your plans are with this money, or we can finance it for 15 years. And then you can make 5% interest. And he was an elderly gentleman. He said, you know what, I'm okay with that. And then we did that. It just, to me, I feel like it's about offering that option. And then not everybody is going to take it. Most of the people are going to go to the traditional route, but it never hurts to ask. I mean, I've done it, I just like offered to one seller and he's like, yeah, I'll take it, give me 5% interest. Yeah, in fact, curious what your thoughts are on that.
Who messaged that? Just so I got their name.
Jeremy Garrido.
Jeremy. So let me say this: 99% of the people out there want a traditional sale. If you can get them full price, their asking price, quick close, no realtor commissions, like everybody wants a cash sale. I'd want a cash sale if I got my price and everything really quick. The reality is most transactions are not that simple, especially in the transition of this market right now, are not that simple. And that's why we're doing a ton of real estate deals consistently and have through up, down markets. But it is very much about the question you ask and the people and how you actually organize and respond with the options. So really being able to master how to solve people's problems through creative financing will dramatically increase your conversion rate. So like, for example, in our offices right now, we'll go ahead and whiteboard at 3:00 when I jump off here, whiteboard out the conversion rates between making a phone call to somebody, getting somebody live on the phone, getting that person live to getting them to be an active lead, and then an active lead to an appointment and then an offer, and then a property, what we call takens under agreement. And we'll look at those conversion rates. Because when we actually look at this though too, Jeremy, the amount of profits you can create from a creative financing deal, in my opinion, is worth going through all the hassle of all those conversions. Because when we look at this as a community, we produce anywhere from $45,000, all the profits from the deal, to almost $250,000 in total profits. So the deal that I'm talking about in Valdesta is a potential $600,000 in profit deal that required 10 grand down. So I just ask you, Jeremy, like, is it worth going through the process and working really hard in order to get yourself to a point where you can master creative financing? My guess is most people say yes. But my follow-up question to Jeremy would be, where's he located? Because the only reason why I'm asking is because this has happened throughout the course of the 8+ years that we've been doing real estate deals, and we'll have student come in to a market that we're working with and say, hey, you can't do deals in this market. They'll fade out, and then another student will come in and they'll blow up doing real estate deals. So Jeremy, if you don't mind me asking, what market are you located
in? He said, I'm part of sub-2 with pace in North Carolina. Have a VA campaign calling in and bringing 3-4 leads today. Haven't converted a deal yet.
Well, that'd be a whole nother thing. How are you going to go through VA training on how to get your VAs to really be able to ask great questions? So North Carolina, we've been doing real estate deals in North Carolina for about 6 years now, in and around the Raleigh, Charlotte area. We have one person that we've been working with. He's actually one of our coaches now. We've done almost 30 deals in and around that area. So 100% can be done.
Cool, man. No, really, really great information, man. I'm just like, I'm like getting some ideas over here with some of the leads that we have where we can say, hey, we'll agree to your price, but you agree to our terms. So I'm really curious about kind of going to so let's say acquire the property with one of, 3 topics that you covered. How do you exit? How do you start making money on that?
Yep. So the 2 ways in which we exit is one's rent to own. So that just simply is right? It's a program to move somebody through from being what we call a tenant buyer, so being a tenant to a buyer. Now I'm going to show you how that actually creates our trademark 3 payday system here in a second. Really what we do is we're going to go ahead and bring a buyer through a very particular process. We have about an 80 to 90% success rate on getting somebody actually to become a homeowner, which is completely upside down compared to the rest of the industry. So we can walk them through a very specific customized program in order to get them to be a homeowner. The second way in which we sell is through owner finance. So if you acquired a property through sub-2 or owner financing and you have the right terms because you have ownership, you now have the ability actually to sell this property in owner financing as well, which is really where you can create long-term wealth on these deals as well, which is additional technique if you didn't just want to hold this property and rent it, right? If you still want to create that long-term wealth. So owner finance and rent to own are the 2 ways in which we exit. The reason why we do this that way is because we have been built to not have to become landlords and managers of properties. We manage a portfolio, not the property itself, because when we place a buyer in the house, they're treated like and they act like homeowners, but they still have their own loan yet. And so we've mastered that process as well. Any questions on how we exit?
So yeah. on the acquisition side, you have owner financing, rent to own, and then lease option, right? And then on the exit, you have rent to own, and then owner finance, and then you can mix and match the acquisition with any of the exit.
So you can do owner financing if you have title. So a lease option, you only have the option to do and when I say you only have the option, this is how we do it in order to create our 3 paydays. But could you, if you're currently a buy and hold investor, utilize any of these techniques to acquire it so you don't have to keep going to banks, right? Most people come to us that are doing the BRRRR method or buy and hold. And what happens is they tend to either run out of capital because you don't have enough 20% downs consistently, or banks are limiting you the amount of properties you can acquire on a consistent basis, unless you're raising capital. And some people just don't want to do that too, right? So by adding this on, by buying at Creative Finance, you can do buy and holds. You can hold these things. If you get the right terms, especially sub-2s and owner finance, you can hold them if you want to, whoever you'd like.
Yeah, so your goal with these is to bring long-term wealth, right? You're not looking for like a quick payday on these. I mean, you are getting like 3 different paydays, which is incredible. You're getting money upfront as a down payment, then you're getting monthly cash flow, and then you're getting at the end when the person buys you out.
Yeah, let me walk you through what that looks like. So I would say a majority of people that come to us are interested in going from a W-2 employee to then becoming a real estate and business owner, right? We believe that the fastest way to get someone to eclipse their current salary in order to get them thinking differently and becoming a business owner is utilizing our trademark 3 payday system, because you're getting paid 3 different ways and you're getting large lump sums, which can help equate to somebody's salary in a pretty quick basis versus the buy and hold method. Let's just use that as an example, where you're only getting, say, $300 to $700 a month per property. It takes a long time to get enough monthly cash flow in order to eclipse a $100,000 salary. So we start here. We start with, how do I get somebody out of their W-2 job and help them escape today by utilizing this? And then we start thinking about, what's the long-term wealth strategy here, which could be, all right, keep more of these properties, don't exit out of them, or transition some of these properties into long-term buy and hold so you don't get rid of them. But this is always the first stop. So when we do our trademark 3 payday system, the payday 1 is the non-refundable deposit we're collecting up front. So you get a property under agreement, say with a sub-2 owner financing or a lease option, you get under agreement, you bought at a certain price, certain monthly payment in a certain time frame. You're going to go ahead and sell this property for a higher price. Our buyers are willing and able to pay a premium on the house because they need time to qualify for loan. You're selling it for a higher monthly payment in a certain time frame. So when this buyer comes in the house, and you're now going to collect a large non-refundable deposit, so that's payday 1. Your second payday is now the spread that's coming in. You are not a landlord, so you're not taking over any and all maintenance. The buyer is taking over everything. It is simply cash flow that's happening from collection of the buyer's payment, paying the debt that's on the house, so the mortgage, and collecting the delta. So that's your payday 2. So we've collected money now, we're collecting money monthly, and then at some point in time in this deal, it is going to cash out. And that's when you're going to receive your equity that has been built into the property. And utilizing any of our techniques, even the way we buy a lease option, we're actually structuring for a way that you can actually build equity into a home even if you don't have ownership. So that's what our 3 payday looks like. Let me just give you an example to put some numbers to it. This is our family business numbers over the past 10 years. And that is our average non-refundable deposits, $26,000. Our payday 1, our average payday 2 is about $308 a month per property. And our payday 3 is roughly $35,000. So it's on average about $75,000 a deal.
That's incredible. And then the payday 1, is that based on like a percentage of the price, or how do you come up with that?
Yeah, it's every buyer is going to be structured differently. So it's not like, hey, you have to give me 5% or we don't have a deal. We actually come up with a customized plan, but what we tend to see is somewhere between 3 and 10% down upfront of the increased purchase price or the premium purchase price. So
got it.
That's what, like, say, like a $100,000 or a $600,000 house. It's probably gonna be a higher monthly or higher down payment than that because you're gonna probably get closer to 10%. So I was just giving you some averages there.
And then in payday 2, you can get really creative. You can have lower interest rate on your end, paying to the seller, and then you can have a high interest rate from the buyer, and you can also play around, get creative with the amortization period. I mean, it's a little bit advanced stuff, but you have a lot of different things, a lot of variables that you can move around and get some really decent cash flow on that.
Yeah, let me show you. This is what a business looks like. So this is a year look back, 12 months on 20 deals. There's just 20 real estate deals. And I say just 20. If you're first getting started, I mean, just getting your first deal, totally get it. But when I'm talking to like some wholesalers out there, right, that are doing 10, 20, 30, 40 deals a month at typically a 10 to 20% or $10 to $20,000 commission. When we look at this is a 20 deal look back. This is $1.6 million in created profits in 20 deals, little to no money down, not personally guaranteeing any of this debt and not going to any banks. So within this deal, and this was full disclosure, right? This wasn't our first 20 deals, and it's probably not gonna be yours, but within those first 20 deals, we were able to create $593,000 in non-refundable deposits. And remember, all of this is not, I mean, it's not like the $600,000 came into my pocket day 1. It's coming, portions of it are coming in now. Some of it's coming in 6 months, 12 months. It's being created and now realized over the course of that buyer's term. We've created $6,500 in cash flow on these 20 deals. So $6,500 in cash flow every single month is coming into the business. And then we've then created payday 3s or money in the future that when these deals are cashed out, now you're receiving the $822,000. So this is how you really step off the treadmill in a lot of these deals when it comes to this type of portfolio and how it's created.
A question on payday number 3, how are you coming up with the exit price and what happens? I mean, I'm guessing like there needs to be an appraiser done at that point. What happens in a down market? Like how do you manage that? Or if the property doesn't appraise for what you guys are asking for?
Yeah, good question. So with all of our deals with our buyers, they have options to buy the house. There is no appraisal contingency. So I say that because you're in a leveraged position as the investor. Morally and ethically, are you going to do everything in your power? Or at least that's the way we look at it. Everything in your power in order to try to figure out a way to get this buyer to the finish line. I mean, that's the way we look at it. So if it's in a down market, what happens? You can either split, the difference potentially. Your buyer may have to come up with more money in order to help that appraisal in order to still get that loan. You can extend your agreement if you have the ability to. So now the buyer we can see what the market looks like the following year. Get a secondary appraisal. So there's many ways in which, this could continue to help that buyer be successful. But you as the investor are in a leveraged position because let's look at this. in all reality, you are giving somebody an opportunity to become a homeowner that is not able to become a homeowner right now.
Right.
So their ability to do so is not up to you to help them get there. You're giving them a pathway in order to become successful.
Absolutely. No, I mean, I totally agree. I mean, then you want to keep doing more and more of these rather than trying to like, be, like you said, I mean, your ethics and morals have to come, above anything else. And where are you exiting? I mean, where are you listing these properties? Are you doing on Craigslist? I mean, I would imagine you're not doing this on MLS or anything, right? Or could you do this on MLS?
You could if you want to, but we're typically in all the same places everyone else, Zillow,
Okay.
links, all those places. Our marketing attracts somebody different because it'll say something like, with a good down payment or with a strong down payment, willing to own or finance or willing to do rent to own. So you're attracting those buyers. So and we're also in the basics of like, we'll put a sign in the yard too. So let me give you an example. One of the first deals that we did, there was a mason that drove by this house. It was on the market with a realtor. And the mason knew that he could not afford, or he could afford the property, but he knew he couldn't get a loan because he needed seasoning in order to do so. He was self-employed. He needed to show a bank he needed to make money for 24 months because he was self-employed, which is a large portion of our buyers. As soon as we put a rent to own sign in the yard, he went ahead and approached us. We ended up selling it within 30 days. He had a 10% down payment down right away. So he had the money. He could afford the property. He just knew he couldn't get a bank loan. So he was never going to try at that point in time. So those are some simple techniques, although, not mind blowing, how we attract buyers.
And then I would imagine like once you start doing this, like you start building a database of people that are interested, you might have people, that are looking to buy, like more people looking to buy because, the credit is tough right now. So you might have, a good list of people that are ready to buy. So as you have more houses coming up, you can like include them in your email or text marketing and say, hey, we have this new property coming up. I know we do that with some of our tenants, but this would be really great way to do that with, with your potential buyers also. I think this is incredible, man. I mean, I'm gonna I feel like some of the properties that we're losing out on where, we just cannot agree on the price. I think we're gonna start offering some sort of, hey, we'll agree to your price, but you have to agree to our terms. I mean, there's no harm in asking for that. Like the worst that's gonna happen is they're gonna say no. So what? I mean, at least you have another, exit or another acquisition tool that you're adding to, to already, what you're doing. And then you don't have to put any money out or you don't have to put enough money out. So I think this is fantastic.
Yeah, and I know we're running up out of time here, so I just wanted to throw the link up. So it's just wickedsmartbooks.com/simply. Just wickedsmartbooks.com/simply. All you gotta do is a simple form and we will ship you out at no cost to you our Amazon best-selling books. And also you have the ability to opt into, what we would call a strategy call. We could talk to our team and see if creative financing is a good option for you and working with us and doing deals.
Yeah, I put the link in the chat, guys. If you want to just, click on that, and then we'll also email it out to you when we send the recording out. We'll include this for everyone in the link also.
In full transparency, I knew we weren't going to be able to cover everything in 60 minutes in full. So those resources right there, if you dive through our Real Estate on Your Terms, it's going to go over 3 pages in depth. It's going to go through all of our journeys as a team here. It's also going to go through a bunch of different deals and how we profit and all that stuff as well. So great resource. And to dive in again, absolutely free. And if anything, I just want to change your perspective. If this is the first time you've been, exposed to creative financing, change your perspective on how you look at real estate deals, because there's so many opportunities. If you're brand new, great way to get started. Again, I was a bartender and personal trainer, so you don't need any experience in order to start doing creative financing deals. I didn't. Those of you that are seasoned on this call, great way to pull another couple deals out, of your current lead sources, in order to, make a great portfolio for yourself as well.
Yeah, I mean, Zach, this is incredible information, man. I wasn't honestly, I'd done 1 or 2 creative financing deals way when I first started, but then just kind of got into buying cash. But this, I feel like just an additional option you can offer to the sellers, if for sure they're not agreeing to your price, they're very stuck on their price. there's no harm in doing this. I mean, you're like, hey, I'll offer you a price. You agree to my terms. What's the max you would pay based on the market value? How high would you even go, like 100%? What's your cutoff on that? I'm
Yeah, I
curious.
mean, we've got 100% market value on properties before. The
Okay.
terms have to make a lot of sense. So let me
Terms,
give
yeah.
you an
Makes
example.
sense, yeah.
So I shared with you that deal. Let's see if I could go ahead and pull up a deal for it just so I can answer that question first.
Yeah, I mean, I guess like you can get really creative, right? If somebody wants $200,000 on a $200,000 property, like, all right, I'll offer you this, but you give me like 40-year amortization, interest. I mean, I'm just saying, like,
Well,
0%, 2% interest. Like,
yeah, so like let me
you
give you
can get
this
into that sort
example.
of things.
So this deal I shared with you, we paid roughly market value on this property. The monthly payment on this was $923 principal only payments. So every single month I made a monthly payment on the property. It was $923 went directly off of that overall mortgage balance. So if you look at here, the principal pay down in 48 months is $44,000. So
Wow.
that's how you dramatically pay down on a property. So
Hey.
can you offer even a premium on the house to a seller? Yeah, we could have here because we knew that every single year it was roughly 12 grand was coming out the principal balance. So if I overpaid by $5,000, $10,000 and I get a long enough term, I mean, I'm already below market within the first like 18 months. Within the first 3 years, I'm really below market. So that's how you can utilize, a 0% interest rate.
No, that makes sense, man. I think this is a really incredible way. I mean, I'm just thinking like a couple of deals that we recently passed on because of the price. Now we can say, all right, we'll agree to your price, but these are the terms that you'll, and sometimes, it could be a seller that's really firm on the price and they're super flexible on the terms. They just want their price and they don't really care about the terms. And then you can do that. They just want to have the satisfaction of selling their house for $200,000, what the house next door sold for, or that's what they feel like is the value. But if you can get, all right, I'll give you that, you give me 0%, principal only loan, amortize over whatever time period you feel comfortable, then you have so much flexibility on that property. Now,
even the property I'm standing in right now. So it's a commercial building that we own. We bought it on owner finance. The seller he's a big landowner, owned a lot of commercial property. And he wanted to basically give his family the ability to receive, the benefits of this asset, which would be, the monthly cash flow of having businesses in this building, but did not want his family to have to maintain this property, right? So when he actually ended up passing away, so we're paying his trust right now. We put down a small down payment on this property. We paid principal only payments for almost 12 months on this property. It was about 6 to 12 months. And then it went to a 5.5% interest rate on this building with a 20-year balloon, all being paid to his trust. And on a commercial piece of real estate, without having to go to a bank, without having to put more than a small down payment and pay 5.5% interest rate, it made sense to us, but also made sense to his family, which they always thank us because she's receiving 5.5% interest rate on this building like clockwork, and I don't have to worry about it. So I say that because it's just about solving someone's problem. And sometimes a cash deal does not solve their problem. In estate and tax planning purposes is a really good reason to create an owner financing deal to help a seller maximize the value and maximize the cash flow on a piece of property like this.
No, man, makes sense, man. Yeah, I'm going to talk to my team and we're going to start doing some of this. Thank you again, man. This is incredible information. Yeah, I mean, it opened my mind. Even though I'd done one like way back, I just feel like there's no downside to start offering this to the sellers. I mean, you could still lead with cash. If they don't agree, then you're like, all right, I'll agree to your price. You agree to my terms, and here are my terms. And then you can be flexible. I mean, there's no harm to even paying more than what the market value is if they agree to your terms, and then you can be super creative with the terms. I love that.
Absolutely, my man. Yeah, look forward to you guys take advantage of the free books and everything. We certainly look forward to helping anybody do creative financing deals, and look forward to spend some time with you. I'm sure I'll see you in Tampa in a couple months.
Absolutely.
Before then, Sharad. So
Yep.
Everybody been,
Yeah, Zach, and we'll send the link out to everyone on our email list also. And then yeah, and you can just connect with them and help them out with however they want. Okay.
well, I appreciate everyone being on here. I know you could be a million other places in this world. Everybody enjoy the rest of your day, and look
Thank you,
forward
Zach.
to chatting with you guys again soon. Have an awesome day.
Cool. Thank you.
Bye.
All right. Thank you, everyone. Incredible call. Yeah, I learned a ton. Like the way I look at it is there's really no downside if you guys are doing wholesaling, fix and flip. And what I'm going to start doing in my business is just if the property is in, especially I would imagine this would work really well in your B plus A neighborhood. I think you can start offering this, and like the leverage that you have is the terms. If the seller wants the price, you offer them the price they want, and then you manage it from the terms that you have. I mean, like what Zach was saying, he was able to get 0% interest loan, just principal pay down. That's in 1 year. That's you're paying like $45,000 on that property, and then you still being cash flow positive. I think that's an incredible way to do that. I mean, you can end up paying the property down really quickly and then be cash flow positive and then make some good money. So I'm going to start testing out with my team. On our first option would always be cash. Get it on a like 40, 50, 60% off the value. But if not, we're going to start offering creative financing if price is the only thing we're not able to agree on with the seller. Just offer that and offer them the price and then try to negotiate on the terms. Matthew said, where do we obtain the seller finance agreement? Matthew, Zach said he's going to send it over to me. So as soon as he sends it over to me, we'll email it out to everyone. So you guys have it. And I'll see if I can pull up. I did one like a few years ago with the seller. Honestly, after I had agreed with the seller on the price, I asked him, hey, what are you planning to do with the cash? Would you be okay if I helped you make 5% on, or 5 or 5.5% on interest on the money that I'm going to pay you? He's like, yeah, what do you have in mind? I said, how about, I pay you, I mean, the loan payment came out to $201.65. And I showed him, this is how much I'll pay you. It'll be recorded with the title company and you make a little bit extra money, 5.5% on the money if you don't have any plans. And then he agreed to it. So I think there's no harm in asking. All you do is just offer it to someone. 1 out of 100 people will take it, but then you don't want everyone to be taking it. You just need one person to take accept on that. So cool. All right, guys. Thank you so much for being on the call. Have a great rest of the week. I'll see you guys on next week call. Thank you.